Okay, well, that's a great segue um, to the past indeed. So my PhD is from Princeton, and at Princeton back in the day, many years ago, many decades ago, was a guy called Jack Bogle. He, in his later career, was the guy who started Vanguard, which is now
Hmm.
the largest provider of index funds by some measure. There's also a guy called Burton Malkiel who wrote a influential book called A Random Walk Down Wall Street.
Hmm.
The point of kind of like both of them is that um, it wouldn't be reasonable to think for the average person on the streets that they could outperform the stock market, or even that they could find an active mutual fund manager that would outperform the stock market. And the reason is pretty simple, that if you are fantastically convinced that Tesla is undervalued and you should absolutely buy it, then you're buying that from someone. And that
Right.
someone apparently thinks that you're wrong. Okay, so most trade you can really only rationalize by people disagreeing about whether the stock is over or undervalued. And guess what? One of them is right and the other one is wrong. And it takes a certain amount of conviction of your own abilities to think that you would be the guy who's right and the other person is wrong. And obviously the other person thinks the same thing about you. So, you know, a little bit zooming out of that makes you realize that this whole thing is not just a zero sum game, as you would think. It's actually a negative sum game because you pay commissions in order to trade, right? So, who
Hmm.
actually benefits from that is the market maker, and they make a killing. Anyway, so these two guys came up with the point to say, like, look, why don't we just create a product that doesn't even pretend to want to outperform the market, but just to mimic it, and that at a very low fee. And they have saved investors just billions and billions of dollars in money management fees. And if there's any takeaway individuals should, the listeners here should take away from that is that you should probably consider buying index funds rather than trading individual stocks or cryptocurrencies or whatever, because you're probably losing money doing that, even though you don't like
I
to
would
admit it.
add the caveat here that this very much depends on your investment caveat,
On your
because
investment one.
it's on your investment mandate. Like, like if you have an investment mandate where you say, okay, we want to take a certain amount of risk. I don't want to be like the full-on defender here of the buy side, but I would say there are reasons for, not only outperformance, but you take a particular amount of risk. That's why these comparisons often, do not make sense. Like, comparing hedge funds to indexes and so on and so forth. But yes, okay.
So that's fair. Let's just, for the intellectual entertainment of all people involved, take that one level further. You can buy an index fund that's double leveraged or an exchange traded note that promises you twice the daily return of the S&P 500. So if you want to lever the portfolio, even you can buy that via an index, or more precisely put, an
Right.
exchange traded product. So again, like, this doesn't actually really challenge your conceptual point that there can be reasons to deviate, and we can get to a few of those in a moment. Just like first order, you should have second thoughts about trading individual equities. Anyways, so there were these people, and they hung out at Princeton at our lunch seminars and whatnot. So I
Mm-hmm.
actually know Jack Bogle from back then, and was interested in that. And I also had a classmate who thought about the theory of that, what the societal effects might be, or in particular the effects on competition if we finance professors were successful enough at telling individual MBA students and podcast listeners that they should all buy index products. And this is basically what my research these days is about, to think about what happens if we're really successful with that message and index products become just gigantically large, so that Vanguard or BlackRock or the big index fund providers become the largest shareholders of a whole bunch of firms. So that's and how that changes the governance of these firms and the way they compete and what it all means for capitalism. So that's one topic. The other topic is, what happens if we're successful and all these households now hold less risky and better performing portfolios, and presumably they're going to put more money into the stock market,
Mm-hmm.
which is the whole point. That's the goal of the exercise. But if they do that and demand for stocks goes up, then you would think that the price of stocks also goes up. But if the price of the stocks goes up and the profits stay the same, that means the returns go down.
Right.
All right, I'll say that again because it actually takes a moment of thinking. Right, so the company makes 100 euros or dollars or whatnot of profits every year, and you get to buy it for 1,000. That means you make a 10% return every year. But if you have to pay 2,000 for it, then the return is only 5% anymore, right? So the more people buy the equity, the more the demand for equity goes up, the lower the expected returns going forward. So in a very funny and quirky way, that's actually kind of bad for investors when you think about it, right? So I benefit from buying the index funds. I just advertise that. But I'm hurting you. I'm hurting your expected returns going forward by driving up the price of equity by buying all these indexes. And it just so turns out that in equilibrium, so once I take into account the price impact of all this demand for equities, it might just be that index funds are actually bad for investors, although it's good for every individual one of them. So that's the second quirky point. The third quirky point is, so ETFs have a tax advantage over mutual funds. And presumably that's one of the reasons for the popularity. It's definitely one of the reasons for why I recommend them to individual investors. But, you know, from a perspective of society, having really cheap ways of avoiding taxes is not so clear to be welfare enhancing, let's say. And also we have thousands and thousands of index funds and ETFs these days, which enables you to do a sophisticated form of tax loss harvesting, in case that's a thing that you're familiar with. You know, the notion that when one of your stocks goes down or one of your ETFs goes down, well, you sell it and replace it with one that has very similar characteristics, but not similar in a legal sense, that the tax authorities wouldn't allow you to do that. So that's yet another way how you can save taxes, which is obviously good for the individual, but not obviously good for society. So those are three reasons why indexing may be good for individuals, but it's not obviously good for society.